The old school American dream might tell you that renting is just throwing your money away, wasting it. You might as well burn it, right? It tells you that buying a home in the United States is the ultimate path to wealth. However, in the current US housing market, if you blindly follow that advice, you may set yourself up for a financial trap in the future. With US mortgage rates hovering around the highest they've been in a number of years, combined with historic home prices and an overall shortage of housing supply to meet the demand, the math behind buying a home has simply become a bit tricky and can leave you scratching your head. We've all searched through Zillow and seen the ridiculous prices for some homes, and perhaps you've thought to yourself, how am I ever going to be financially okay when I can't afford one of these houses and everyone tells me that buying a house is the ultimate way to go? In many American cities, buying a home is now 80% more expensive than renting the exact same property. Now that's a heck of a lot. Today, I'm going to show you why buying isn't always the best financial way forward, and how different cities and different types of people may require prolonged renting over buying for the best in future personal finances. And I'll show you how you can work all this out for yourself. It's not too hard, I promise you. Okay, so let's do some numbers. Suppose you want to buy a house at $400,000, so a pretty reasonable home. You did the responsible thing and put down a 10% down payment, so that's $40,000, which leaves you with a loan balance of $360,000. However, there's something that people often forget about, and it plays such a big role in buying a house with a mortgage. That's interest. At a 6.8% interest rate, which is pretty standard these days, your base monthly principal and interest payment is roughly $2,347. But that's the principal and the interest. When you break it down, you are only putting $307 towards the principal, which is basically your total $360,000 loan balance. And with that, over $2,000 in interest. So when people tell you that money is building for positive equity when you're buying a house, it is, but only $307 of it. The other thing that many first-time home buyers forget is that this is just a monthly baseline. It doesn't include all your hidden extra costs that you didn't know would hit you. Add on an average US property tax bill of $350 a month. A typical home insurance for a $400,000 home will also set you back another $150 a month. Because you put less than 20% down, you also have to pay private mortgage insurance, or PMI for short, costing you around $150 a month. And finally, I would say a conservative $250 a month for general maintenance and HOA fees. Therefore, we can look at this and see that your actual out-of-pocket monthly expense isn't $2,300, it's $3,297. And remember, that's just for $307 of equity to start. To get the full picture, in the first few years of that 30-year loan, almost 80% of your monthly payment goes purely towards paying bank interest and hidden fees. Buying a house like this isn't building you equity or wealth, it's costing you more money. So with that in mind, you may have always been told that renting is like burning money. Well, we have just seen that buying may in fact be more like burning money. This is what many call the renting myth. Now let's look at the alternative. Let's say in the exact same market, renting an equivalent home costs an average of $2,100 a month. Side by side, we can see that renting, you are putting aside almost $1,200 a month to start with. So in theory, by renting, you are able to save that $1,200 a month, rather than only build $307 of equity. Now, as I'm sure many of you already know, investing in a solid index fund can bring you an average yield of around 10% a year. The S&P 500 has historically hit these figures consistently, and so the potential here is really significant for long-term financial growth. You can also use that initial down payment as an initial investment, and that kickstarts your wealth building. If we assume a 10% rate of return, but take off 3% for inflation, that gives us our 7% real growth rate. Now, as we can see, if we track that over 30 years, which is the time you would have the mortgage for, we can see that this would bring over $1.7 million. As the growth compounds over many years and the interest works for you and really starts to do the heavy lifting in the later years. Obviously, this is far higher than the $400,000. And it's also still likely to be higher than whatever the value of the house is written to. Therefore, In theory, renting over a long period of time can bring you greater wealth in the future, but that's not the only benefit. Renting over buying can give personal benefits, such as less stress, as you don't have to worry with meeting the large mortgage payments each month, or about having no money left in your bank account when you spend your deposit. It also provides greater flexibility to move. Generally, maintenance costs will be handled by the owner of the property too. More cash invested gives far greater liquidity if your situation changes. And with lower monthly costs, your scope for budgeting is broader. However, it is important to remember getting a fixed mortgage can also bring you some level of stability, as you know exactly what is happening with your money, whereas with investing, there are no guarantees. So with no option being perfect, how do you decide whether to rent or buy in a specific city? Many investors use a metric called the price to rent ratio. You start by calculating the median home price in your local market and dividing it by the total annual rent of a comparable home. If this ratio is 15 or lower, buying is historically a fantastic deal. However, if the final ratio falls between 16 and 20, you should be cautious and likely move towards renting. But if the ratio is higher than 20, you should absolutely rent, as buying would be a terrible financial move. Right now, major cities such as San Francisco, New York, and Los Angeles are all well above 20 and are a terrible financial deal for buyers. Ultimately, the decision really comes down to which city you decide to live in and personal lifestyle factors. If you plan to live in the same house for less than 5 to 7 years, renting allows you to keep central liquid, invest heavily, and protect yourself from a potential real estate correction. However, if you are planning to settle down for 15 to 30 years, want a predictable housing cost that will never face a landlord rent increase, and can comfortably afford the monthly payments without draining your emergency fund, buying still makes sense for peace of mind.